The list of demands sounds almost casual. President Trump stands before the cameras, outlining what he expects from Beijing. Start buying American soybeans again, stop the flow of fentanyl crossing borders, and above all, don't manipulate the rare earth supply. At first glance, these seem like reasonable requests, the sort of talking points one might expect in any trade negotiation. But behind this familiar language, something far deeper is unfolding. The global trade system, built over decades of cooperation and interdependence, is beginning to fracture. While Washington projects confidence and Beijing maintains its characteristic diplomatic composure, the real confrontation is playing out far from summit halls or policy speeches. It's happening in cargo terminals, processing plants, and the narrow waterways that tie continents together. China isn't threatening war or making loud declarations. Instead, it's quietly repositioning the infrastructure that keeps global commerce moving. Across the world's busiest shipping routes, port operators linked to Chinese state enterprises are introducing new fee structures for international cargo. Individually, these adjustments seem trivial, a few dollars here, a small procedural change there. But when you control enough terminals across enough regions, those minor shifts start to add up. Shipping costs rise, delivery schedules slip, and suddenly, American exporters find their margins disappearing. This is precision economic warfare. Every time the United States imposes new tariffs, Beijing answers, not with press conferences, but by subtly recalibrating the systems that underpin global trade. The American economy depends on these same maritime routes to move agricultural goods, energy supplies, and manufactured products around the world. Yet increasingly, many of the key junctions in those routes are controlled by entities that ultimately answer to Beijing. What began as a simple disagreement over trade balances has evolved into something far more consequential, a struggle over who will shape the rules of global commerce for the decades ahead. And honestly, the first moves in that contest aren't coming from Washington's declarations, but from the quiet, methodical actions already unfolding across the oceans. The next announcement sounded almost bureaucratic. A new $56 per metric ton charge on American-flagged vessels using Chinese ports. On paper, it reads like a modest administrative fee. But when you calculate its impact across the massive trade volume between the world's two largest economies, the numbers become staggering. Shipping companies are projecting losses in the hundreds of millions each month. Exporters who thought they had stable cost structures are watching their profit models collapse. Yet the real significance of this policy isn't the fee itself. It's the infrastructure that enables China to impose it. Over the past 20 years, Beijing has systematically acquired ownership stakes or operational control in more than 100 port facilities across nearly 70 countries, from Colombo to Piraeus, from Douala to Antwerp. These aren't just commercial ventures. They form a deliberate network spanning every continent, all integrated into the Belt and Road Initiative, China's trillion-dollar infrastructure strategy, and arguably the most ambitious economic project since the Marshall Plan. Unlike past great powers, China isn't projecting influence through military bases or troops. It's doing so through cranes, long-term lease agreements, and port access deals that grant its cargo preferential treatment. Now, imagine Beijing decides to extend this pricing policy beyond its own ports. If partner facilities across Asia, Africa, Europe, and Latin America adopt similar surcharges on American vessels, the global economics of United States exports would shift dramatically. Insurance premiums would rise, shipping firms would reroute vessels to avoid unfavorable ports, and every new cost would eventually land on American businesses and consumers, already strained by inflation. Meanwhile, Chinese cargo continues moving freely through the same network under entirely different conditions. State-backed shipping companies enjoy subsidized rates, priority berthing, and streamlined customs. This isn't theoretical. It's already happening in ports from Southeast Asia to the Mediterranean. The contrast with American strategy couldn't be starker. For decades, Washington projected its global influence through military alliances and defense bases. Beijing studied that model and chose another path. Where America built bases, China built logistics. Where America stationed soldiers, China placed cranes and containers. And while United States policymakers debate sanctions and export controls, China's maritime empire expands, one terminal agreement at a time. The world's trading routes are being quietly reorganized, and whoever controls the choke points controls far more than trade. But ports are only one front in this growing contest. Beneath the surface, another battle is escalating, one that could determine which nation dominates the technologies of the 21st century. Inside Washington, behind closed doors at the Pentagon, the Department of Energy, and the White House, officials are scrambling to address a crisis few outside the system truly understand. China has begun restricting exports of rare earth elements, and American industry is feeling the strain. These 17 obscure metals, names like neodymium, praseodymium, dysprosium, and terbium, are vital to nearly every modern technology. Electric vehicles, smartphones, advanced semiconductors, and perhaps most importantly, precision-guided missiles and radar systems all depend on them. And China controls nearly the entire supply chain, from mining to refinement. In recent months, Beijing has tightened export permits for gallium and germanium, two metals critical to semiconductor and defense technologies. The ripple effects are immediate. U.S. defense contractors are reviewing their stockpiles nervously. Electronics manufacturers are searching for alternatives that don't exist yet. If Beijing can limit access to materials essential for advanced weapon systems, it gains a kind of power that doesn't require a single missile launch. The Trump administration's response has been to pour investment into alternative supply chains, buying stakes in mines across Australia, Africa, and beyond, an attempt to build a rare earth network independent of Chinese control. Financial markets reacted instantly. Mining stocks soared, some by more than 300% in a matter of weeks. But that optimism misses the real bottleneck. Mining isn't the problem. Refining is. Pulling ore from the ground is only the first step. Turning that ore into usable materials is the hard part, and China controls up to 95% of the world's refining capacity. Even if the U.S. mines its own rare earths, the material would still have to be shipped to China for processing. Without that step, the ore is useless. Just expensive rocks sitting in storage yards. Building new refineries is no quick fix. Each one takes 5 to 7 years to complete and costs hundreds of millions. Western environmental and safety regulations, while necessary, add more complexity, the kind that China's state-backed model can simply ignore. That's why every confident promise of American rare earth independence eventually runs up against the same wall. China's control over the processing stage. As restrictions tighten and prices rise, the pressure on U.S. manufacturers, from electric vehicles to semiconductors to advanced defense systems, continues to grow. The contest over these obscure elements is no longer about who can dig them up. It's about who controls the industrial furnaces that turn them into the backbone of modern technology. Washington may be digging, but Beijing controls the refineries. And while U.S. officials struggle to contain this materials crisis, the trade war is wreaking havoc on another vital pillar of America's economy, its agricultural heartland. Trump's latest ultimatum to Beijing carried 3 key demands. Stop the fentanyl smuggling networks, resume large-scale soybean purchases, and lift the export restrictions on rare earths. China's response has been a calculated silence and a complete shift in buying behavior. Since June, Chinese imports of American soybeans have nearly stopped altogether. The result has been devastating for rural America. For millions of farming families across America's Midwest, soybeans are far more than an export or a line on a commodities chart. They're the thin line between financial survival and generational collapse. The numbers paint a grim picture. At the height of U.S.-China agricultural trade, Beijing bought over 30 million tons of American soybeans every year. That market has now vanished. Instead, China is importing record amounts from Brazil and Argentina, completely redrawing global agricultural trade routes. The estimated loss to U.S. farmers already exceeds $12 billion, and that number keeps climbing. Across Iowa, Illinois, Kansas, and neighboring states, this isn't a distant policy issue debated in Washington. It's fields full of crops with nowhere to go. It's silos bursting with unsold soybeans. It's commodity prices falling so low they no longer cover production costs. Families who've worked the same soil for generations now face foreclosure and the slow unraveling of rural life. Washington's reaction has been to unleash emergency aid at a scale rarely seen outside natural disasters. Tens of billions in federal subsidies and bailout payments have already gone out, and projections suggest that if China's boycott continues, total support could surpass $60 billion. But for most farmers, these payments barely keep their operations alive. They don't replace spoiled harvests, offset the growing cost of storage, or fix the domino effect of falling local prices that ripples through every agribusiness in the region. During a press conference, President Trump was asked directly, "Do you think China will make a deal on soybeans?" "I do believe so," he said, "because otherwise, I won't make a deal. Our farmers have been boycotted by China as a negotiating tactic. I don't want that. Our farmers are great, especially our soybean farmers. And I want them to start buying soybeans again, at least at the level they were before. But that before no longer exists. Before, there were no 100% tariffs crippling trade. Before, global markets hadn't yet turned against American economic policy. Before, there wasn't a trade conflict this deep or this bitter. Now, Chinese importers are signing multi-year supply contracts with Brazilian and Argentine producers. They're investing in new processing facilities across Asia designed specifically for South American crops. They're even building logistics networks that completely bypass U.S. agricultural exports. Even if diplomatic relations were to thaw, many experts believe American farmers may never fully recover the market position they've lost. This isn't just an export crisis. It's the slow financial suffocation of rural America. Small towns already struggling with shrinking populations, aging infrastructure, and limited opportunities are now being squeezed even tighter. As Washington pours billions into keeping farms afloat, the cost of this trade war is shifting from Chinese ports directly onto American main streets. And the damage doesn't stop with agriculture. The same tariffs meant to punish China are quietly transforming into something else entirely: a hidden tax on American consumers. The trade war was originally sold as a tool to pressure Beijing into concessions. But somewhere between the speeches and the actual policy rollout, its economic burden flipped direction. The tariffs designed to hurt China have instead become a tax on American households and businesses. Here's how it works. Every time a container ship arrives at a U.S. port carrying Chinese goods, tariffs are charged at customs. Importers pay that fee, then pass it on to wholesalers, who pass it to retailers, and eventually to the consumer. Families buying electronics, furniture, clothing, or everyday goods never see a line on their receipt labeled tariff. They just notice that prices keep rising in an economy already strained by inflation. Government data shows that U.S. tariff revenue hit nearly $30 billion in a single month, one of the highest collections on record. At the current pace, annual revenue could exceed $350 billion by 2026. That may sound like a success, until you realize where that money comes from. It's not China footing the bill, it's American consumers and businesses. Beijing's treasury remains untouched. U.S. household savings, on the other hand, are being quietly drained. Then, something even more ironic happens. Washington takes that tariff revenue and uses it to fund subsidies and bailouts for the very industries being hurt by those same tariffs. Farmers get emergency payments financed by tariff income. Manufacturers struggling with higher input costs receive federal aid from the same pool. It's a circular system. Consumers pay more, the government collects the difference, and then redistributes it to keep key sectors from collapsing. China, meanwhile, sits back and watches this internal loop unfold. The real difference lies in how each country funds its economic strategy. Beijing subsidizes its industries using massive trade surpluses, real profits from selling far more than it imports. Its annual surplus now tops $800 billion, providing a steady stream of capital that flows back into infrastructure, research and development, and advanced manufacturing. The U.S., by contrast, funds its support programs through deficit spending and borrowed money. Washington borrows to prop up industries, adding to a national debt that has already surpassed $35 trillion. Every 1% rise in interest rates costs American taxpayers tens of billions more each year. This structural difference determines which side can endure longer. A country funding its strategy with earnings can sustain it indefinitely. One funding it with debt and taxes cannot. China can maintain subsidies as long as needed. Washington, meanwhile, is essentially borrowing from its own future to survive today's conflict. The tariff system has become something its creators never envisioned, a mechanism that raises costs across the entire American supply chain while giving the illusion of striking back. Instead of weakening China, it's tightening economic pressure at home, raising prices for families, and pushing the government deeper into debt. The appearance of strength masks a deeper imbalance. America's attempt to project power through tariffs is now feeding its own inflation and fiscal strain. And as that cycle intensifies, one question grows louder. How long can Washington afford to keep funding its own trade war? Despite years of tariffs, sanctions, and fiery rhetoric, China's export machine keeps running at full capacity. Shipments to the U.S. have dropped by roughly 25% from their 2022 peak, yet China's total global exports have hit record highs. The reason is simple: Beijing has rerouted its trade. As the American market has contracted, China has deepened ties across Southeast Asia, the Middle East, Latin America, and Africa, forging new demand and reshaping global trade flows that increasingly bypass the United States altogether. The result is a sustained $800 billion trade surplus, a reservoir of capital constantly reinvested into technology, infrastructure, and advanced industry. This surplus is Beijing's quiet weapon stable, self-replenishing, and immensely powerful. Unlike Washington, China doesn't need to borrow to maintain economic momentum. Chinese government bond yields remain below 2.5%, reflecting investor confidence. In the U.S., by contrast, 10-year Treasury yields hover around 4.6 to 6%, driving up the cost of servicing the nation's massive debt. Every percentage point of interest adds billions in taxpayer burden, money that could otherwise fund infrastructure, education, or innovation. This contrast now defines the global economic balance. China's model, built on production and reinvestment, continues to gain ground. America's model, built on consumption and debt, is starting to show strain. According to Harvard's Growth Lab, China's industrial complexity ranking has risen from 37th in 1995 to nearly equal the United States by 2023. That ranking measures how sophisticated and diverse a country's manufacturing capabilities are, and the data tells a clear story. China now produces one of the widest ranges of advanced products in the world. Its industries have climbed the value chain, from basic manufacturing to electric vehicles, from assembly lines to AI processors. Meanwhile, U.S. industries face rising costs from tariffs and mounting competition from heavily subsidized Chinese firms. While Washington debates policy, Beijing builds factories, expands supply chains, and ships products at a record pace. The American economy isn't collapsing, but it's increasingly playing defense while China plays offense. And as Washington catches its breath from one economic front, Another is already opening, this time in Europe. The Dutch government recently made a bold move, seizing control of Nexperia, a major semiconductor firm with Chinese ownership, citing national security risks. The goal was to protect Europe's strategic industries and assert technological sovereignty. But that decision may have unleashed consequences European leaders didn't anticipate. Officially, Beijing's response was calm. Behind the scenes, however, Chinese state media and officials quietly warned that the move could have long-term repercussions for Europe's access to critical materials. That's where Europe's vulnerability becomes clear. The continent's clean energy transition, defense sector, and semiconductor industry all depend heavily on rare earth elements, and the vast majority of those are refined in China. In 2023, the EU imported over 6,000 tons of rare earths from China, roughly 46% of its total supply. Another 3,700 tons came from Russia, bringing combined dependence on the two nations to nearly 80%. Even efforts to diversify, sourcing from Malaysia, Australia, or others, face the same bottleneck: limited refining capacity outside China. Prices for key elements like neodymium and dysprosium, essential for EV motors, wind turbines, and advanced electronics, have already surged 25% since mid-2024, and could easily double if Beijing tightens restrictions further. During a recent summit, European officials admitted the truth. China has weaponized supply chains, and this is a threat to global trade. The statement is correct. But when your entire industrial base depends on the very nation you're criticizing, acknowledgement alone changes nothing. Take ASML, Europe's crown jewel in advanced manufacturing. The Dutch firm produces EUV lithography machines, the most sophisticated tools used in cutting-edge chip fabrication. Each one costs between $100 million and $350 million, representing the pinnacle of European engineering. Yet even ASML relies on rare earths: neodymium, praseodymium, terbium, dysprosium, and yttrium, most of which are processed almost exclusively in China. Even with current stockpiles, a serious restriction from Beijing could disrupt production within months. ASML's entire value proposition, its ability to produce the most advanced semiconductor equipment in the world, ultimately depends on Chinese refining. Following the Nexperia seizure, reports surfaced that Chinese managers within the company's European operations were instructed to ignore directives from Dutch headquarters and instead take orders directly from Beijing.